I'm market analyst Michael Filighera of Traders Helping Traders with the Eye of the Storm podcast, helping you make informed trading decisions for the week ahead. And good evening, everybody. Welcome to the Eye of the Storm podcast. With my guest today is a very special guest to me because it's my first teacher in Elliott Wave and someone that I've been friends with, hate to say it, Dan, but about 30 years. And I know time flies when you're having fun. And we've done a lot of work together, and I've always admired Dan's work. So before I actually introduce him, I want to kind of fill in some blanks so that other people know him as well as I do. So I'm going to talk about that, what Dan has done and where he's been and where he's going to. So a little bit about Dan. After Dan earned his bachelor's degrees in economics and psychology from UCLA, he began his career as a stockbroker in the early 1980s. I know I'm dating ourselves. And by 1984, he hosted his own financial television show. Dan also appeared regularly on financial programs on CNBC, Bloomberg, KWHY in Los Angeles, and other financial stations across the country. Dan hosted the Defending Your Money radio show from 2009 to 2012. That show is now a part of defendingyourmoney.com and is available on the World Wide Web, YouTube, and wherever you might get your podcasts. Dan's experience also comes from his professional experience as a money manager, futures trader, and market research publisher. Dan also ran a hedge fund and was instrumental in developing and executing the strategies for the initial family of Rydex funds, a Cappiello-Rushmore fund, and a gold exchange traded fund. In the 2000s, Dan's work was critical in pioneering securitized gold, now found in exchange traded funds, and forming a cornerstone of portfolio allocation. Dan has also spoken at many domestic and world financial conferences and has edited and or published popular newsletters such as the Elliott Wave Currency and Commodity Forecast, the Elliott Wave Theorist telephone hotline, which was the world's first 900 line, Stock Market Signals, the popular newsletter and research publication, The Global Market Strategist. This is where I personally started publishing with Dan, and the Safe Money Report and Profits Without Borders. Dan's deep knowledge of how the markets function comes from getting down in the weeds, trading futures, stocks, and options, and working with and learning from institutions to develop and execute strategies and develop quantitative models. Dan's path has led him to embrace modern trends in the financial market strategies and hedging that has tweaked his desire to make these sophisticated institutional strategies public in the form of his publications, radio and TV shows, and now YouTube and podcasts. His path also led him to put together a global consortium of institutions and a government agency with the goal of developing and bringing to the market the first gold exchange traded fund. Dan continues to publish financial market research and advice on defendingyourmoney.com and also publishes a sister service for traders and investors, Pro Trader Alert. Welcome, Dan Ascani, my friend, that I am so excited that we finally got our time together so that we could do this podcast. Welcome.
Thank you, Michael. It's really great to be here. And, it's been a good 30 years of friendship. We might be dating ourselves, but it's a great 30 years, and I'm glad to be here.
Thank you. And so today, because I will be honest, Dan, you are the reason I am the gold bug that I am today. And I am not sorry for 1 second, because you opened my eyes, you gave me the information, you taught me what this was all about. And Dan is the only person I know, folks, that actually has 500 years of data pertaining to gold. And so his depth of knowledge is very, very deep. So I'm going to turn our conversation over to Dan as we talk about today. And I believe, Dan, you're titling today, Tapping the Power of Gold.
Tapping the power of gold and build your wealth. And just a little background on that and on what you said about the 500 years of data. So in 1997, I wrote and published the first version, the first edition, I should say, called Gold in a Deflationary Economy, because I felt that after a bull market in stocks started in the 80s and accelerated in the 90s, and the way the whole economic situation was going and what the Fed was doing, and then the tech bubble that expanded into 1999, 2000, and then collapsed, but that there was going to be a period of deflation, in fact, even a deflationary depression. Mm. And so I felt that investors really needed to understand the true value of gold and what gold's function is and how to understand it and why it's a store of value. So I called it Gold in a Deflationary Economy because we hadn't had deflation since the 30s.
Right.
And now suddenly that's what it looked like to me, that we were going to end up in some sort of deflationary collapse. Not necessarily right then. I wanted people to be well prepared ahead of time. So it was called Gold in a Deflationary Economy. And the years of data I got were actually from an out of print book called The Golden Constant, written by Professor Roy Jastrom of the University of California at Berkeley.
Right.
He's long gone. I believe he died in the 70s, I believe. But that book's out of print. You can't even get it, but thank God I got a copy of it about 25 years or so ago. And he published the methodology behind his, basically an index. So what he did was, how do you analyze almost 500 years of data? The actual number is like 463 years as of 2023, but we're going on 5 centuries of data there. Right. How do you analyze that? That predates the existence of the United States. Right. I mean, that goes back a long time. So what he was able to do was create an index, and I'll go into that a little bit more, but an index of commodities, not just gold, but commodities. For example, wheat prices and other, gold prices and so forth, so that if you look at that index, there's a few conclusions that can be drawn. And I thought it was brilliant, and I was glad he published the methodology because I was able to continue it, and I'm still continuing it, and it still works. It still sheds a lot of light on the true function of gold, inflation, deflation, and so forth. So the golden constant really is a concept where gold returns to a constant value over time. Basically it's parity. It returns to parity. So if you look at almost 500 years ago and started there, and let's say you assign an index value of 100 to gold and wheat and commodities, and then you look at the true purchasing power of gold, which is very important, the purchasing power of gold, not the price in US dollars or euros or whatever. That's important, but the true value and the true way to understand the value of gold and understand its function and understand why it's been a kingpin of financial systems for millennia, back to the Roman Empire even, but basically gold-backed currency, the gold standard, et cetera. It's been the kingpin of the financial systems that we've had. And so if you look at that index and you understand that it returns to a constant value in terms of what it can purchase, then you understand a little bit more about gold.
Makes total sense. Total sense to me. So, okay. So, beginning with that, because I think what we're going to we're doing is, if we're going to try to explain to people how we trap the power of gold and defend and preserve our wealth, then we got to go back to that beginning. So, shall we start by talking about the 70s?
Yes. So what I had published in our newsletters and reports that we published in the 90s, as well as Gold in a Deflationary Economy, was that you can characterize each decade in terms of what they represented. This is a very broad representation, but the 1970s, you could say, were the decade of commodities. In 1971, the United States dropped the gold standard.
Right.
And all of a sudden, everything's a free-for-all. We have paper currency. It's not backed by gold anymore. And commodities took off. Gold took off. That was a decade of commodities. Stocks stalled out, didn't give you any returns to speak of.
Right.
Gold took off, and everyone knows the famous, I think everyone knows the famous gold rally into 1980, where gold spent the decade off and on of the 70s going to almost $900 an ounce. So the 1970s were the decade of commodities, as we characterize it. The 1980s were the decade of paper. Gold had peaked in 1980, silver, commodities, they all peaked. And then we went into a period where interest rates were so high. Remember the Paul Volcker Fed and the last fight with inflation, where, you know, the 3-month T-bill, I think, went as high as 16%, and other interest rates were 20%. That kind of put the brakes on commodities. And
sure did.
In 1982, stocks took off, and it became what we call the decade of paper. The 1980s really the decade of paper. 1990s continue on. Stocks went up. Still, paper assets were prominent. I called it the decade of currency, the 1990s, because you had a lot of exchange rate activity. You had central banks constantly manipulating the currency. They would, you'd have central bankers call the floor of the currency pits, the currency futures pits, to get a quote, and that kind of scared everybody. Put everybody.
I remember in that period of time, I was on the European Options Exchange, and they were going through the European rate mechanism debacle. And I can remember calling you and saying, "Oh my God, you're not going to believe this. Sweden is paying 500% overnight, and so-and-so is paying this." And we were just flabbergasted between each other, like, what? I'm like, how is this ever going to be counted? How are we ever going to figure out where these currencies are in terms of an Elliott count? I remember having those conversations, but we were both just kind of dumbfounded by what was physically happening around us with interest rates.
Yeah, so there was a lot of currency manipulation by central banks. They were trying to control currencies, put them where they wanted them to be, the various central banks of the world. So it's a decade of currency. And then you also had, you know, paper assets exploding, the stock market, for example. And you still had gold, which had periods of gold and silver and commodities, periods of rally, but gold didn't really bottom again after its peak in 1980 until 1997/8. And then a double bottom occurred in 2001. 1997 was when I published Gold in a Deflationary Economy, and then called the decade of 2000, saying I expected it to be the decade of gold and a deflationary collapse. First, though, we had to run up. We had to, because of what the Fed was doing and pumping the markets up and so forth, run up the market. There was a housing bubble, as everyone knows, the famous housing peak in 2006/7, and then the collapse, and then the crash of 2008. That was a deflationary collapse. That was really a complete failure of the global monetary system.
Right.
And the central banks patched it back up, put some Band-Aids on it, put it on oxygen and intensive care, and then tried to pump their way out of it, tried to continue to pump money into the economy. The famous Fed's quantitative easing, QE, where the Fed not only dropped interest rates to zero, but it actively and right in the open, with full admission and not even hiding the fact that it's buying bonds. It's buying mortgage-backed securities, even stocks, although I didn't do that for a while. But the Fed's trying to manipulate us out of that failure of the system and keep the status quo in power. That's a whole nother podcast in itself. But, you know, that's the decade of gold and the deflationary collapse. 2010s, we could call the decade of deflation and Fed manipulation. And there's other things you can call it. Here we are in the 2020s, the 2020s, and maybe we can still leave a question mark behind that one, but there's going to be a lot of change in the 20s.
Yes. Yes, there will be. Undeniably, there will be, because the madness continues. And I think there's many things, and you and I have discussed some of them, as to why things are they're changing. And delineating a little bit from what we would consider the norm or what we would expect in such a period of time. And a lot of that is because I believe that everything, when it comes down to trading, has now become quantitative. Trading and everything is quantitative. It's quantitative, it's algorithmically controlled. And down to the fact that you can now get a program that's going to count Elliott for you, which I find very, very interesting, because I don't see how, because it's going to do it algorithmically versus the whole concept of why R.N. Elliott developed this and what it really was based on. And it wasn't based on a quantitative model. It wasn't based on, it was based on human emotional reactions. And so I find that very interesting. But maybe we could just touch on some of those very strong changes that have happened because of quantitative trading. Everything is computerized. We know about quantitative easing, QE, we got all that down. But then how some of these other things have really come into play because of the increase in the derivatives and just the increase of participation, and how all of this injected capital into our monetary system has produced its own set of really severe problems that, like you were mentioning before, I don't think that people that are trading now really have an understanding of what that all means, because they've never experienced it before. As you said just a moment ago, the last period that we had runaway inflation was 1981. Many of the people that are trading today weren't born yet. Those of us that were and in the market at the time make a realization that, yes, what was happening then is different than what's happening now. And the number one reason is because the money supply has increased 45% since 2020 to 2022 versus 35% in 1970 to 1980. So the biggest thing is just the amount of capital, the amount of money that was created. And so when I try to compare that period of inflation in 1980, which ran our inflation up to, how high did it get? I think 9 or 10%.
Yeah, there might have even been a spike up to 12 in the way the government calculates it, but yeah, 9,
Right.
10,
right. But then we saw interest rates. I think the Fed funds got as high as, like you mentioned, 20, but that was also a spike, and then it came right back down, more balancing itself out at 18%. But I'm getting a lot of arguments from people today saying, oh, that can never happen because there were such differences. So what was an 18% interest rate in 1981 would equal about a 5% now. And I'm like, I don't necessarily see that, but okay. So I just think that the differences that we're talking about, and then like one of the points that I know that you want us to understand is that inflation and deflation are monetary phenomena.
Yes,
so
absolutely.
What I'd like to do, because I know you're going to start bringing in some good stuff here, I'm going to switch over and I am going to, so that you can share your screen with us when you are ready. So I'm going to go over here and I'm going to just bear with me 1 second, folks, while I get that done. And I'm going to go over here and go down to here. And I'm going to put it over to Mr. Ascani. So you are now in control. So when you're ready to share your screen and put up what you need to share with us, you go right ahead. But maybe we can get a little bit clearer understanding on how inflation and deflation are definitively monetary phenomena.
Yes, and in each of the editions, Gold in a Deflationary Economy, which is the first edition in 1997. The next one in 2009, I called Tapping the Power of Gold to Defend and Build Your Wealth. And that's going to be really the third one. I'm updating that right now. So there'll be a 2023 edition that we'll make available. And in each edition, I talk about that. I talk about the importance of understanding what inflation and deflation really is. So when people hear the word inflation, they think rising prices. And of course, that is what's happening. But those rising prices are a symptom of the monetary phenomenon causing inflation. And falling prices during deflation are a symptom of the monetary phenomenon or actions that occur that cause falling prices. So as an example, we talked about the 1970s, and then now we've got severely rising prices again. Now we had them in the 70s. People are resurrecting discussions about the Paul Volcker Fed, who really jammed on the brakes. But that sort of explains it right there. The Fed jammed on the brakes. So in the, for example, the COVID lockdown, the COVID crash, which came about 12 years after the crash of 08 slash 09.
Right.
The 08-09, what did the Fed do? They dropped interest rates to zero and pumped tons of money. They expanded their balance sheet by buying treasury bonds, mortgage-backed securities, etc., transferring over to the Fed's balance sheet, and which in turn, in exchange for that, put money into the economy. So they pumped and pumped and pumped money into the economy. Why didn't that cause inflation then? Because we were in a deflationary collapse that was a monetary phenomenon. So as an example, think about the fractional reserve system that the banking system is on now. So when you deposit money at a bank, let's say $100 for the sake of example, the bank only has to have 12% of that in reserve. And that's varied. It was 8% at one time, 9, 12, whatever. The point is, the bank only actually has to have in reserve about a tenth or an eighth of what you deposit. They take the rest of that and lend it out. So that means they're creating money. They're creating an expansion of the monetary base by lending out money that's on deposit. So let's say $88 of your $100 deposit are lent out to someone else in the form of a mortgage or whatever else. So that's expanding things. It's creating, it contributes to the creation of inflation. Think of the opposite. What was happening in the 08 crash? Housing was collapsing.
Yes.
And the whole thing was in reverse. All of a sudden, that money, that expansion that was created is now in reverse, collapsing. It's contracting. Now, the banks are not only having to put more and more money in loan loss reserves because everything was collapsing, but it was contracting everything. So the Fed was trying to compensate by pumping tons of money in, and that didn't cause inflation because, well, first of all, it's a monetary phenomenon. And secondly, the Fed was just trying to counteract what was happening. I often use a bathtub example. Why wasn't inflation caused then? If you fill the bathtub with water and then open the drain, let's say that's the 08 crash, you open the drain and money's draining out of the economy, then you turn on the faucet, it's not going to raise the level of water in the bathtub, and it's not going to overflow into inflation because it's draining out the bottom. So the Fed was compensating for what was happening, trying to save the system and trying to continue its experiment that started when we dropped the gold standard in 1971, and we had central banks, being the wizards behind the curtain to try to conduct an economy or a financial system based on paper currency, fiat currency. So fast forward to the 2020 COVID crash. That was a lockdown, of course, of the economy. The market crashed, but that was a very brief and quick crash. And then the economy reopened and the market recovered. The government, and I don't want to just blame this all on the Fed, although they should be accountable, but the government, through its stimulus packages, the fiscal stimulus, the Congress approved trillions of dollars. I think it was a total of almost $6 trillion.
Yes.
The bathtub drain was not open then. We didn't have a deflationary collapse going on. So they opened the spigots, they opened the faucets, filled the bathtub without the drain being open, and it overflowed into inflation. That's why this time we have an inflation problem. It's monetary based. There's been too much stimulus. People have had, or still have, too much money, because they go out and spend. And that's what everybody likes. That's what the Fed likes. That's what corporations like. That's what politicians like. Yeah, spend your money so we can have an economic expansion. But the problem is then you get yourself in trouble. The Fed and the government get themselves in trouble by too much stimulus. The Fed's balance sheet has expanded all the way to $8 trillion, and now they're trying to drain it back off.
And I think that's really what presents the problem, because they cannot get it off fast enough.
Exactly.
And from what I understand, there's still, when we talk about the money supply, we talk about the money that's in the market being shifted around. At year end, between the accumulation distribution stuff that was going on, what do we like, what do we don't like, there ends up supposedly like $6.1 trillion just kind of out there looking for alpha, as they call it, because alpha being money, where it can earn money. And it just stunned me that there's such a huge amount of money still being given to asset managers, to fund managers, to place it somewhere, and they have no idea what they should be doing, because I don't think there's a solid enough understanding of what you're explaining right now.
Exactly. And what do people do? They got money. The government was handing out checks, COVID stimulus, pandemic stimulus, whatever you want to call it. And people received that money. And then what happened? We got an asset bubble or two. There goes the stock market again, inflating into a bubble with rampant speculation. The GameStop, gamma squeeze, all that kind of stuff in January 2021, and even thereafter, at least until this year. So, and people went out and spent, and then we have inflation. So you give people money, they're going to go spend it. That's going to drive prices up, and that was compounded by the supply chain deficiencies and shortages that occurred because of COVID. And then it was hard for companies to plan to, how do you control inventory coming out of a pandemic lockdown when we don't even have much of a playbook for that? And remember, that's also on the back of the Trump tariffs. And so you've got all kinds of reasons why there were supply chain shortages, but we don't want to blame them all on supply chain shortages. We're talking about the monetary phenomenon of inflation and deflation. I just kind of gave a general example. And so that's important to understand, that the rising and falling prices of things are actually a symptom of that monetary phenomenon. But the whole point of publishing Golden Deflationary Economy and then updating it in 2009 and again now is to point out that people can understand what happens during inflation and deflation. And they can understand the true function of gold, because people, I'm amazed at how people parade across the financial media and whatever else, analysts, I should say, or whoever, asset manager, whoever, kind of just poo-pooing gold, saying, gold doesn't really return anything. And it's something that you buy when you're afraid of war or when times are bad or whatever. And, that may be partly true, but they're kind of missing the point as to what gold is. It's really a conservator of operational wealth. And I discussed that in the Deflate Gold report, as did Professor Roy Jasterman in the Gold and Constant book in the 70s. Gold it conserves operational wealth. What is operational wealth? It's what a person can do with their wealth in terms of how much they can buy. So it's important to understand that when you look at gold and we look at inflation and deflation, what really matters is what you can buy, your operational wealth. So most people, I think Milton Friedman called it money illusion. Mm-hmm. The money illusion was where people pay attention to nominal prices instead of the real purchasing power, instead of operational wealth. So people can say, I've got $100,000 in the bank, and I'm leaving it there as my safe money. And if you leave it there for long enough, let's say 10 years or more, it's going to approximately halve itself, depending on the rate of inflation, in purchasing power. So you might still have $100,000 in the bank after 10 years or whatever the number is. But now it only buys half of what the goods that it bought 10 years ago.
Right.
That's the money illusion that Milton Friedman talked about. But the true value of gold is understanding its operational wealth, understanding people's operational wealth and how it preserves that. So operational wealth is I might have had $100,000 10 years ago, but instead of putting it in the bank, I'm going to put it in something that preserves my operational wealth. And I'm not advocating putting all your money in gold by any means. I would say do not do that. But as an example, the $100,000, if that were $100,000 worth of gold, 10 years go by. In fact, centuries have gone by according to the data we have and that Professor Roy Jastrom obtained. That time goes by and gold still buys what it bought 10, 20, 30, 100 years ago. They say an ounce of gold has always bought a man's fine suit, no matter what it costs. Take an ounce of gold, you can buy a pretty good suit. So maybe 25 years ago when I wrote the first gold report, an ounce of gold bought a $300, $400, or $500 suit, whatever the case was.
Right.
Now gold's at $1,800, $1,900 an ounce. That buys a pretty good suit too, and it still costs 1 ounce of gold. But now, if you used your U.S. dollars, you have to come up with 1,900 of them, as opposed to 300 of them, 25, 30 years ago. That's operational wealth. And I often use the example of how many gallons of gas it buys. Just take a look at the price of gold. Let's just say at the turn of the millennium, coming into 2000, when gas was around $1 plus or minus, it was 86 cents and it was $1.03, whatever. An ounce of gold bought approximately 300 gallons of gas.
Right.
I have exact numbers in the report, but just for the purposes of discussion here, an ounce of gold bought 300 gallons of gas, roughly.
Right.
And it costs $1 a gallon, roughly. Fast forward to now, what is it now, depending on where you live? But it's $5, $6, $7 a gallon. But gold went up to 1,900. It was at 2,000 something last year. Sure, it fluctuates, so you got to be careful. It's a risky commodity if you're using it as an investment. But as the illustration that Professor Roy and that I carried on, it's $1,900 an ounce right now, roughly. How many gallons of gas would that buy? Do the math. It's still 300 and something gallons of gas. In fact, I think it buys a little more than it did 25 years ago. It buys about.
I'm going to ask 1 second. If I don't turn the light up, I'm going to turn into a ghost here.
Okay.
So, and I know this goes out, so give me 1 second while I.
Meanwhile, I'll switch the screen here.
There it is.
So I've just got what I'm discussing here is key points to understand about gold, currency, and inflation and deflation.
Right.
And one of those is inflation is a monetary phenomenon. We just went over that. The golden constant, gold returns to its purchasing power parity over time. In fact, Professor Roy Jastrom developed an index that he called the purchasing power of gold. Exactly what I'm saying. How much does an ounce of gold buy, or how much does that index buy in terms of a basket of commodities? So you can take a basket of commodities almost 500 years ago, standardize it in terms of an index, and follow that for the whole time, and follow it now. And you could see gold always, over the long term, returning to purchasing power parity, basically. So if you assign gold a value of 100, for example, in that index, when the Federal Reserve was created in 1913, and you fast forwarded in time to now, gold still hovers around that that 100 index point. It maintains its value.
Right.
It maintains its ability to buy goods and services as a store of value. Whereas if you look at a chart of paper currency since the Fed was incepted in 1913, the charter might have been 1914, but it was that famous Jekyll Island meeting in 1913 when they formed it. If you look at the value of paper currency, the dollar, for example, it's less than a cent, 1 cent. So if the dollar were worth $1 in 1913, it's worth less than a cent now, yet gold is still worth the dollar. So that's the point of this particular discussion and research in the gold report. That is understanding operational wealth, understanding the money illusion, where people pay attention to nominal prices, like is gold at 1,500 or is that 2,000? And I bought it at 1,500. I made $500. That's not the point of it. That's good, but it's not the point of it. The point of it is what it buys.
Right.
And if you keep going down the list here, we can take a couple of periods out of the original gold report. I have a couple of deflationary periods and a couple of inflationary periods that we can talk about just to see what gold did. And I think people will be surprised that gold actually is a better hedge against deflation than inflation. Why is that? Because during deflation, you have serious economic problems causing deflation, and that's reducing the purchasing power of the dollar, a paper currency. Gold is actually becomes very valuable because it not only holds its value, it actually goes up in terms of purchasing power. I can illustrate that in a second. So, and gold leads the way. So why did gold, for example, go to 2000, I think it was 2070 an ounce in 1921? And then when inflation hit and the Fed finally realized that we're in an inflationary period and started to tighten and raise interest rates and reverse quantitative ease, quantitative tighten beginning in I think it was March 2022. Why was gold beginning to drop, and why did gold fall all the way to 1,600 and change before it bottomed while inflation is accelerated? Because gold leads the way. Gold moves first and pulls commodities towards it. Roy Jastrom called it the retrieval phenomenon. Gold moves and then retrieves everything else towards it. Gold eases off, retrieves everything towards it. Not that we have to fluctuate exactly with gold, because it's going to fluctuate even in times of an uptrend. Then it surges again, and what you're really hedging against, what gold is really protecting against, is a loss of purchasing power of your money, the debasement of our own currency, debased by the very central banks whose responsibility partly is to preserve the value of the dollar, for example. So you look at the dollar in terms of euro and how many yen you can exchange it for or whatever. It seems like it's holding its value, but those currencies are losing long-term purchasing power also. Gold is not. Look at the price of gold in terms of dollars, yen, euro, whatever, in the last 20 years, 30 years, or let alone 500. And you'll see exactly what I mean. So if you look at one of the periods of deflation, the deflation of 1814 to 1836, just to give an example. I'm going to try to get that chart up here. This is the original Gold and Deflationary Economy report from 1997. I'm flashing here, and those who can't see it and they're listening to the audio only, we're going to make this available to you pretty soon, at least the updated version. But let's go to this period of deflation, 1814 to 1836. Yeah, that's the period I said. The duration of that was 16 years. Commodity prices dropped 50% during that period, that 16-year period. But the purchasing power of gold rose 100%. It doubled in terms of the basket of commodities it could buy, even though we were on the gold standard. So if you look at the chart that's on the screen and that's in the report that you'll see, if you can't see it now, gold was fixed. So the gold price index was steady. Gold was fixed. We were on a form of the gold standard, and it was fixed in terms of the number of dollars per ounce of gold. If you plot wholesale commodity prices in terms of the index that I was talking about that Jastrom created, and we call this the Jastrom study, the deflation of 1814 to 30, and then you look at the purchasing power of gold index, gold actually went up during that deflationary period because it could then, at the end of that period, buy twice the amount of commodities it could buy before that, when the period started. And you could look at period after period like that. You could even look at the period of the inflation of 1897 to 1920, for example. That was an inflationary period. We were on the classic gold standard. That was when the United Kingdom dominated world trade. And we were on the classic gold standard, where issuers of money were required to hold sufficient gold reserves to handle the demands of individuals who wanted to redeem their currencies into lawful money. And also, a country could actually demand being paid for their trade of goods with another country in gold. So that was a period of inflation lasting 23 years. Commodity prices increased 232%, but the purchasing power of gold dropped 70%. That's exactly what I mean. Purchasing power of gold increases substantially during deflation, and then holds its value, but then as inflation catches up, this is the retrieval phenomenon again, as inflation catches up and prices rise, gold has already discounted that. Everything else is really just kind of catching up.
Mm-hmm.
So you've got a period of inflation and a period of inflation where gold is actually lagging. And you can go through various periods like that. You can go through periods of deflation, you can go through periods of inflation and see the same phenomenon. The long-term return to purchasing power parity, the purchasing power of gold as a constant, the golden constant over time, and the fluctuation of commodity prices up and down, even in periods of fixed gold prices and fixed currency exchange rates. So if gold was fixed to a certain number of ounces of gold, excuse me, if the dollar was fixed to a certain number of ounces of gold, and it's fixed there for years, you still have fluctuation in the purchasing power of gold. And that occurs over time, and you could just keep going through these periods over and over until you see that this whole experience, we call it the American experience now, basically since 1933, when we collapsed into the Depression, the government made holding gold illegal and then promptly raised the fixed price of gold. So they confiscated gold from the public and then enjoyed the appreciation of gold themselves, the government did, because it was trying to keep itself from going bankrupt. And I guess that worked because we didn't go bankrupt. We didn't default on our debt. The United States recovered. We ended up winning World War II. And then in 1944, we had the Bretton Woods Conference, which then kind of modified the gold standard into what we call the gold exchange standard. Instead of the classic gold standard, it's the gold exchange standard. And a period where the United States began to mint the world reserve currency. What that means is, we won the war. Every other place, almost every other place, was destroyed and had to be rebuilt. And world trade was conducted in US dollars. So we have minted the world reserve currency since we won World War II.
Right.
That advantage of the country that mints the world reserve currency is called seigniorage. Seigniorage is basically the profit a country makes by minting the currency, minting the world reserve currency. So the United States enjoys that profit just by being the country that mints the world reserve currency. Right now, it's the dollar. But it enjoys that advantage of seigniorage, that profit. And that's what other countries now are becoming a little bit tired of.
Yeah.
China's central bank has been accumulating tons of gold.
They sure have.
The Russian central bank and other central banks are buying gold. In fact, according to the World Gold Council, in their research report, 2022 saw the biggest accumulation of gold by central banks since 1967.
Right.
Think about it. Gold just bottomed a little bit above 1,600, and now it's moving up again. When central banks buy like that en masse, it tends to put a floor on gold, and people in the industry know that. That happened in right after the crash of 08, 09. In 2010, 11, you look back, and the Chinese central bank was buying the heck out of gold. When it was around 800, 900, 1,000 in that area, that put a floor on gold. It never went under there again and went straight up to high of 2011, went into a bear market for a while, and now here we are again, rising, and there's more central bank accumulation.
And speaking of that, speaking of the central banks of the world beginning to purchase more gold, one thing that I've been talking about within the podcast and also within my updates is that we are going to be moving to a digital currency. The Central Bank of China has already introduced the digital yuan to the public, and it's really raising a lot of concern from a lot of different angles, but primarily the fact is that I think that what we've watched happen, and just a tangent for just a moment over to cryptocurrencies, to that market, in the fact that Bitcoin in and of itself is a byproduct of the blockchain that drove it. So in other words, the technology to create the currency, to move the currency, to cut out the middleman, aka the bank, to transfer wealth, is truly what needs to happen when you digitalize your currency. But I think that what really stepped up this buying of gold, because if you're going to intend to switch your currency from this fiat system that we have, which we know really doesn't work, and that it's very weak in terms of what can happen, as we've now witnessed, and you and I have discussed, in terms of, look at the number of mini crashes and all of the things that happen that before would be more structured in terms, not structured, but they would be more cyclical in terms of not happening as quick and as often as they are right now. And I think that that has a great deal to say about our currency and the global currencies, and how they're not backed by anything but the good faith and credit of the country which issues the paper. And if we really look at that and go like, well, gee, the United States used to have some pretty good credit, and faith, but we're starting to waver. Why? Because of the monetary mistakes, because of the injecting so much capital into the system. We overdo it, and we're not the only country that's doing that. So when I see that China, and by the way, Russia, not only are they just taking gold, but they're already, and you mentioned this before, but in terms of, purchasing power of gold, they are taking gold in payment of oil. They're selling their cheap oil because they have to come in under the radar with it, but they're building up their own reserves of gold by accepting that in payment. Now, you watch all this stuff happen and then listen to our Fed and go like, is anybody paying really attention? Do you guys want to tell the truth now or never, and just keep this illusion of really what's going on? And so I find it very interesting, everything that you're adding to this conversation and what we've witnessed. Particularly, I'm watching this, what you've got on the screen right now, the deflation of 1920 to 1933, how the purchasing power of gold increased by 251%. I think if what we're hearing from some of people in the marketplace, that inflation is going to be on the downswing, I think that people need to truly understand, and you've mentioned this now a couple of times, what comes next. If we have this great period of inflation, okay, if that's peaking, what comes next? And you've got the word right there on the screen.
Exactly. If you look at the periods of inflation and deflation in that almost 500 years of data that Roy Jastrow originally obtained, and from 1976 on, I updated it. If you look at those periods, it alternates between inflation and deflation very regularly, although each period is a different length. So I say regularly, what I mean is each cycle of inflation has been followed by deflation, which has been followed by inflation, and then deflation, and so forth. Some of the periods are elongated or shortened by economic circumstances. So this period of deflation, 1920 to 33, everyone knows basically what happened then. I mean, you had the roaring 20s and the 29 crash and the collapse and the deflationary depression. There was a lot of debt repudiation, a lot of debt defaults. The United States was even trying to keep from going bankrupt itself. I mean, it was a bad time. And that is in stark contrast to what happened after World War I. And the pandemic of back then, the Spanish flu of a little over 100 years ago, when we had a spike in commodity prices, and then the roaring 20s, and then the deflationary collapse. Then you look after that, it may take a few years, but then inflation starts to build at some point, and then you get a period where you're still alternating between inflation and deflation. The crash of 08, 09, and that was a deflationary episode. Now we're back to inflation. What lies after this at some point is expected to be deflation again.
So, exactly. And so I think even if we're just using how you've laid it out here, we had the 2008, 2009, right? Big problems that we all started by the mortgages. We all understand that. But then we went into this great thing of deflation. We got inflated again. But then you talk about a pandemic, which was coupled with, 1920, with the end of World War I or the starting of World War I. But now we've had that period. We now have had this reinflation. Then we get the COVID, which was its own little crash. So are we now we're zipping up high again in another period of inflation? If we just follow history here, would that not suggest that we've got some serious downside laying out there waiting to get triggered?
Look what's already happening. The seeds are already being sown for the next deflationary episode. We're coming out of another asset bubble, not just in stocks, but in cryptocurrency like Bitcoin and in real estate, stocks, the GameStop type gamma squeeze,
et cetera, et cetera, et cetera.
Et cetera, right. And then now look what's happening. The Fed is raising interest rates at a record pace and trying to drain assets off its balance sheet. That's deflationary. Now it's reversing what happened before. They were buying after the 08-09 crash. They're buying mortgage-backed securities, treasuries, et cetera. And by doing that, they're receiving the securities and then paying whoever sold them to them, let's say the banks. So they're pumping money. Now that's reversed. Now they're wanting to drain their balance sheet, and they're starting by letting certain shorter-term maturities mature. And they're just getting started with this. And all we need is another little crisis, and they'll be probably reversing course. But the seeds are being sown, if you think about it, for next deflationary cycle. It might take a little while, but they're already raising interest rates. Things are slowing. And if they overshoot.
How strong are you on the belief that I've always felt that, because I actually, I don't want to show my age, but I was a fan of Paul Volcker. And in terms of, I admire his work and I admire his strength in terms of stepping up to the plate and going like, you're not going to like this, but we got to get a hold of what's going on out there. And the only way we're going to do it is to take away your money. We have to stop you from borrowing. All right. So we got to stop the spigot. And the only way I can do that is I got to take it out of your reach. Now, and he did it really quickly, which did put the kibosh on, what was happening back then, and did take us to a point where we could start over again. We got through all that, and then we went back into that. We went into one of a great bull market, so to speak, right? So I see what we're doing now, and I'm like, yes, they're waffling between 50 basis points and 75 basis points. I'm like, wait a minute. Unemployment is still at, where is it now? 7%? Inflation is still at 6.6%, which I don't like the number, but hey, and I think a lot of it is done through smoke and mirrors, which we discussed very, very briefly. You touched on it. The way that the Fed reports year over year figures, it's like, it's so inaccurate. It's just not realistic. But yet that's a number that kind of, and the model that goes in to telling us what CPI and PPI are, and we see what the reactions are. We see how they're jumping on it. We're seeing this desperate need of people, because they've always been taught, you just buy and hold, you buy and hold, you buy and hold. It's like, there are other ways to trade, which hopefully you and I are going to be teaching them. But I don't know. I just see it coming, and the Fed continuing to hold to, well, our target is 2% inflation. I was like, I cannot believe that they sit around the table, all those Fed governors, and maybe Janet's in there too, and they're talking like, oh yeah, 2%, that's a realistic goal. We're just going to get back there. It's like, by raising by 3/4 of a basis point at a time. Meanwhile, everybody blows you off and continues to borrow, continues to do what they do and deal with inflation because you have put so much money in the system. And so I say that the only way any of this is ever going to come into terms with itself and be controllable is after the Fed through their line of smoke and mirror is actually debasing the currency.
Exactly. And there's another part to that. So we're talking a lot about the Fed, and that's true. But what Congress and the government does in terms of fiscal stimulus, or the lack thereof, but right now it's stimulus, stimulus, stimulus. What the government does is very important. In fact, Jay Powell, the Fed chairman, has mentioned that in a couple of his, or maybe more than a couple of his speeches. Maybe the government could step in here with some good fiscal policy. He didn't say it in those words, but
right.
when you look at the monetary phenomenon and the fact that inflation deflation is a monetary phenomenon, and you look at what the Fed does, but you also have the government in there, because you got to have the Treasury supplying the treasuries for the Fed to buy and sell, that pumps the money into the system. So, they don't actually print money. They actually are buying bonds, and then that's a whole different transaction, a whole different subject there. But yeah, so the other part to that is the fiscal policy of the government.
Right. So I want to kind of try and tie this all up. By the way, folks, Dan and I have already agreed that we're going to be doing probably part 1, part 2, part 3. So this conversation will continue. But in an effort to kind of contain our time to a reasonable amount, let's just kind of go. Your last slide is titled 1933 to 2000, a period of unprecedented. So 90 years and counting. I agree with the 90 years, but I think that is coming, and we can almost declare it closed. Would you agree or not agree? Because my Elliott count basically says that the supercycle wave 3 began in 1932, so that's close enough to 1933, and completed in 2022. So is this period now drawn to a close, and we are going to get ready to tip over and kind of do our thing?
Yes, I could very well be. So I put the period 1933 to 2000 question mark, because we want to close that period when it's evident that it's closed. But yeah, we can go down the path that you're discussing here and look at the lag effect or the lead effect. The stock market's going to lead the way. Gold prices are going to lead the way. The markets are going to lead the way, and there's a lag. There's a lag effect. So a lot of people are criticizing the Fed for raising rates too fast, like just because they thought inflation was transitory and now they are correcting their mistake. But what they're doing is, by raising rates at a record rate but not allowing for the time lags for that to filter through the economy, and that could really cause the Fed to overshoot. That's why I call the Fed kind of the wizards behind the curtain, and we're the guinea pigs in the experiment they're conducting. Because how much control do we have over it? I guess we can go public and start complaining about it, but what the Fed is doing is really compensating for their own mistake of thinking inflation was transitory, and then they're raising rates fast. And I don't know if the Fed has ever actually engineered a soft landing, or maybe not even been fully responsible for a hard landing. I mean, the economy and what's going on in the markets naturally have a lot to do with that too, not just the Fed and the government.
Could see the possibility of a soft landing, because if I'm believing that the Central Bank of China and Russia and India and the European Central Bank and also our own central bank are now buffeting and building up their gold reserves. And I find that could provide us that soft landing as they prepare to jump back off of the fiat currency, introducing a digitalized currency, which in my mind, the failure of Bitcoin, the crash and the volatility we've seen in Bitcoin, I'm like, hey, central bank, is that what you want in the dollar? Because you digitalize it without anything to say, this is what you get. That's what's going to happen. Who's going to have the good faith and credit in any country that's not backing a currency that's digital? I mean, if we don't learn our lesson from what we just witnessed with what some people call the big Ponzi scheme of Bitcoin or cryptocurrencies, then yes, we are in deep trouble. But,
right. It's tough to be a wizard behind the curtain, they're trying, but we're honestly the guinea pigs. And the experiment I referred to is by dropping the gold standard, you've now released monetary and fiscal policy from the market itself, because gold, on the gold standard, on a pure gold standard, gold is going to keep governments in control, because if they get out of whack with their gold reserves in terms of what they're backing, in terms of the currency they're backing, interest rates start to rise or fluctuate, and things that happened in the 60s, for example, happen. Part of the reason we dropped the gold standard was under that gold exchange standard at the time, a foreign country had the option of saying, you know what, I want you to pay me for these goods and services I just did with you and our world trade in gold. And the country would have to put gold on a ship and send it there if they actually complied with that demand. And there's a lot of talk about what France did in the 60s, really challenging the US on hey, pay us for this trade in gold. And and we were running the Vietnam War, and then Nixon said, you know what, forget it. We're dropping the gold standard. And that's one reason governments, especially the United States, never liked the gold standard, because it puts a strict, austere leash on the government. And they can't do their agenda. They can't stimulate, and they can't do the things they've been doing. And, that's, again, another discussion, but that's what's happening. That's where we are.
It is where we are, and it's kind of a scary thing. Now, one thing that I want to make sure that we include, because we're gonna wrap up part one, as I keep an eye on the clock here, that I want to make sure, and in fact, I'm going to go ahead and give that back to you so you can show it on your screen, because I want you to detail it and basically tell people about where they can get a hold of you and the other things that you were discussing before we started.
Right. So hopefully you can see that. And then for those who can't, I'm going to just talk about it for a second. What I put up there is we're going to make this next update, which I'm working on right now, to Gold and Deflationary Economy, available to people. The first edition, again, was 1997, Gold and Deflationary Economy. We've talked about that a lot today in the original Jastrom study and the Golden Constant, etc. I updated it in 2009 and called it Tapping the Power of Gold to Defend and Build Your Wealth, because that's what I feel people can do. Don't run out and put your life savings in gold. I'm not saying that, but it can be used if you use it properly, understanding the risks. You can use it to help defend and build your wealth. Third edition is going to be pretty much the same. It'll just be the third edition, the same name, I mean, but with years of update. And we've had a lot happen since that 2009 update, not just in the price of gold, but inflation, deflation, and what's going on. So we're going to make this available to listeners to Eye of the Storm. All you have to do is either go to my website, defendingyourmoney.com, or send me an email at info@defendingyourmoney.com, and in the body of the text, type EOS 2023. That's Eye of the Storm 2023, EOS 2023, and we'll give you 33% off the listed price of that new report coming out, which is listed at $59. We'll give you a third off for $39.50.
Which is wonderful. Thank you so much for that. Now, you just mentioned something, and I want to make sure that people understand how they can get a hold of you, because you said a couple of times, and we're not advocating in any way, shape, or form to please go out and to put all of your wealth into gold. But there is methodology, there are ways, and there are plans that you have written and you have created. How can people get a hold of you if they send you an email at info@defendingyourmoney and ask how you can help them develop a portfolio?
Yes, we have various services that we can discuss, and if we're talking about one-on-one there, that's going to depend on the person. So it'll obviously be customized to the person and their situation, because everybody's different. And that's one reason I'm underscoring here. Don't go out and put your life savings in gold. I hear so many stories about people who did that in Bitcoin or real estate or stocks. And it's the same story over and over. They just get creamed when that cycle breaks, and it's hard for them to tell. It's hard for anyone to tell when that cycle peaks. You and I make good educated research. We try to anyway, but commodities involve risk, and you got to understand that. So it's got to be proportioned properly with your situation. So yes, the services we provide will partly be customizing it and partly be research reports like this. And we have other reports coming out soon, and a blog and so forth.
Great. As we wrap up part one, and you see how I say that, folks, because I've now just committed Dan to doing part two, which we actually agreed to prior to this. I want to state again that you send an email to Dan, and you can do that at info@defendingyourmoney.com. Also, do check out defendingyourmoney.com, because there are other things that are available there that are going to help you as you navigate this, what is going to turn into probably a very difficult economic period. And don't forget, you're going to type EOS 2023 in the body of an email that you send to Dan to receive 33% off the listed price of the first two reports. Would that be correct?
Actually, it would be the current report. I mean, the one I'm updating now, the 2023 edition, that's not quite done yet as of January 2023. We expect it to be out soon. And we'll have improvements in the website, by the way. Defendingyourmoney.com is really still being constructed. I originally had that in the crash of 08, 09, a radio show. It was all called defendingyourmoney.com. I'm resurrecting that now. So if you're in January or February 2023, bear with us while we improve that site and get it running well. But that's what it is. So it'll be the latest report that I'm updating now. It'll be out soon. Tapping the Power of Gold to Defend and Build Your Wealth, 3rd edition.
But the first and the 2nd edition will also become available via the website at some point, correct? But this particular special offer will be for that 3rd edition.
Yes. The 3rd
and if they want the first two, they can get those two.
Right.
Not necessarily not with this special offer, but it will be available.
A lot of what's in the first two will be in this 3rd one. So what I'm doing is I'm updating.
Just wait for the 3rd one. Good idea.
Yeah, I'm updating another 12, 13, 14 years of all kinds of stuff that's happened, including the failure of our financial system and the band-aiding it back up. And, as we go through time on defendingyourmoney.com, we're going to be talking a lot about what lies ahead, what people can expect, because there are obviously a lot of things going on, a lot of change, a lot of things happening.
And we now just experience how quickly an hour flies by, and we can barely really touch upon a lot of things, which is why I will be doing additional podcasts with Dan. But for today, I really want to thank Dan for coming on, sharing his knowledge, his work with all of us today. And should you have any questions, folks, you can email Dan again at info@Dan Ascani or at defendingyourmoney.com. Also, on YouTube, you can leave in the comment section. Or if you're listening to this on your favorite podcast, then you can also email Dan at info@defendingyourmoney.com, or you can email me at michael@mjf1partners.com. And we will answer your questions, and we will direct you to where you can find your answers for your questions. So again, Dan, I want to thank you very, very much for joining me today. And kind of hang out for just a second, because I'm going to cut this off, but I want to say thank you. Thank you very, very much. And stay tuned, folks. The next one will be up soon.
And thank you for having me, Michael. I've enjoyed it and look forward to the next one.
Great. Good night, everybody.